Ian Campbell with Alpha Capital. Mark L is my partner. We're both the financial advisors on your plan. And today we're going to go over the online enrollment process, but also talk a little bit more about the benefits of the 401k plan, why it's important to save for retirement, how much to save, how to pick investments, and things like that. So we'll go ahead and jump right in. Scott, I did shoot you an email this morning with these attachments. The documents that are in that email can also just simply be forwarded to all the eligible participants in the plan. After this call, we'll make that YouTube video link of this recording available as well for folks to watch that, and we'll include that in that email as well. And then you can just simply forward that out. All participants can reach out to us one-on-one with any help or assistance they would like. If there's any questions that they have about any of the details here or anything else financially related to the 401k plan, we're more than happy to help and assist. The first document that I'm actually got pulled up on my screen is what's called the online enrollment packet. If you forget anything today, just reference back this 15-page document. This has really almost 99% of the stuff that we're going to be talking about and going through today on the call. With that being said, in the body of the email that we'll send, we'll actually have the first step automatically in there as well. I'm going to scroll down to the second page, and this is really where the heart is, all of it. The first process for folks is to go to the website of the record keeper or the provider, which is Retirement Plan Consultants. And this website link is going to get you to that login screen. And I've actually got the login screen pulled up on in an internet browser here, so I can show you kind of what it looks like. So that web page will actually work as all of your future logins as well. So make sure to bookmark this. It'll make it easier when you're trying to access your 401k account into the future. For the initial step, you have to do this once, which is the online enrollment. It's up in that top left corner of this gray box. You'll click that. It'll flip the screen and ask you for a plan password. And the plan password is specific to this business. It's actually WINGS and then SOU, all in capital letters. So make sure you are putting in that in all capital letters and you're putting that in there. Once you select next on that, it'll then follow the guided steps of the onboarding of that online enrollment. And on page 8 of the, or actually on page 9 of this document, it starts those screenshots. And just very similar to what I just showed you, go to this website, click online enrollment in the top left corner. It'll ask you to type in that plan password, again, WINGS, SOU, in all capital letters. And then you go through those onboarding steps to putting in your date of birth, social security number, and setting up your username and password for your login. There is one step that kind of hangs up people if they don't read through this onboarding step process here, is once you are done selecting the type of money, you know, pre-tax or after-tax contributions, and then the how much you're going to be saving, there's a spot right at the 50% completion mark of the onboarding flow is you'll select the source of money. And just make sure everybody is selecting all sources of money when they're going through that step. So you'll get to that step and you'll be like, okay, I read it all over, and you're like, oh, what do I need to do? Just click all sources of money and then hit next. And then the next couple pages are just again, the same workflow of picking investment choices, confirmation page, and so on. So please, definitely review, pages 9 through 15 as you're going through that onboarding workflow. If there's any questions, feel free to reach out to us as well. But the biggest piece is this let's get started page of going to the website, online enrollment, and then typing in that plan password. And for the purposes of the call today and the webinar, we find it best to just go to the actual paper PDF form and go through the types of questions and the types of information that you'll be filling out to give you a little bit more of a heads up of what type of information you'll need. So the first part, you're going to be putting in your contact information, all pretty self-explanatory. The one piece that might be unique that you don't have at the fingertips is going to be your date of hire. So make sure you're getting with Scott and confirming your date of hire, making sure that those eligible employees have that information as well as they're completing the online enrollment. And then the next section we'll spend a little bit more time on is the enrollment election down here. Scott, this is going to be important for you and also any employees that don't want to participate at this time. This form, this 2-page form, is in that PDF enrollment packet. It's the second and third page of that 55-page document. So if there are an employee that doesn't want to participate in the plan at this time, they'll actually fill out this top section and select this first option. I elect not to contribute in the plan at this time. They would have to fill out this form as a waiver that they've been presented the benefit. They'll return it to you, and then you'll just keep that on your records. It's kind of one of those cover your butt things, is that the employee's been presented the benefit. At that time, they wanted to not participate. You'll keep that on your file for your records. You do not need to keep updating that if the answer is still no. But if the employee does say no now, but in the future they say, yes, I want to participate, they'll just simply go online and enroll online or complete a new paper enrollment form to get that process started rather than just saying no still. For those who do want to participate, which is kind of the first question, is hopefully everybody does want to participate, which is very important. You can choose from either a pre-tax contribution or an after-tax contribution. And the difference between the two is essentially when the money is taxed. A pre-tax, or that first one that I've highlighted, or traditional, is probably what most people are familiar with. You're going to put money in today, and then when you withdraw the money in retirement, that's when you'll pay the taxes. And then the opposite happens with a Roth contribution. It's after tax. So you're going to pay taxes on your money today, and then put in money that you've already paid taxes on. And then in turn, when you withdraw that money in retirement, the government is not there to take the tax money because you've already paid it, when you put it in. So depending on what your tax bracket is today and what you foresee taxes to be in the future, one may be better than the other for you. Because we don't know what tax rates are going to be in 10, 20, 30, 40 years from now, it's still somewhat of a best guess. But a general rule of thumb is if you're earlier in your working career, you're younger, you're probably making a little less in money than you would be in 10, 20 years from now. So your tax bracket may be lower now than it would be in the future. So you want to pay your effective tax rate at a lower rate now versus what you're in retirement. But the opposite, the contrary, could happen too, is in retirement, you're not making any money anymore, and you're just paying taxes on whatever you're withdrawing. We normally see it kind of breaking even over a course of a time. There's not really a positive side of either of them to where one's going to outweigh the other. It's normally best to kind of hedge bets and do a combination of both in most cases, or when you're earlier in your working career, do Roth. When you need the deduction in income, do the pre-tax contribution. I'm going to pause there, Scott, or do you have any questions on the traditional versus Roth?
No, I understand them both.
Okay, great. So going to the next question, which is the how much, which is equally important. The national average of all age groups and all industries, all states across the country are saving around 8% of their income, and that's their personal contributions. So use that as kind of a watermark to get to be at the average. If you were to, either of us were to go on Google and say, how much should I be saving for retirement? Every single article that you'll probably read is going to say 10% or more. So as a magic number, try to get to that 10% goal. It's very important for folks to save for retirement, but it's also important to save enough for retirement. And getting to that national average of 8 or even up to that 10% goal is really, really recommended. It may not be in the cards right now from a budget standpoint for all of you to put in 8% or 10%. But starting out at something like 5% is a good number to start out at, and then bumping up your contribution by 1% annually. So limping into that bigger number. So starting out at 5, maybe for January 1, and then next year go to 6. The following year go to 7, and so on, ultimately getting up to that 8% number or 10% number. And we tend to see that 1% move up is not really all that felt on your net take-home pay all that much. So one other scenario I did want to explain on just the how much is kind of a sample paycheck idea. In the event, I'm just going to say, you're making $1,000 gross for your paycheck per week. And that $1,000 paycheck, you're going to save 5% in a pre-tax contribution, or this one in blue that I've highlighted. And that's $50. So you're going to save $50 into your 401k account per $1,000 check. And that $50 is going to go in before you pay taxes. But your net take-home pay in that example would technically only go down, in the average tax bracket, would only go down to about $30. So you're putting and saving $50, but your net take-home pay is only going to go down by about 30. So just having that mentality is whatever you're saving today, if it's in a pre-tax contribution, is that it's not going to affect your paycheck to that full amount. It's going to be some degree less. So keep that in mind. If you guys have any questions about the contribution rate or any ideas or any thoughts on that, feel free to reach out to us. We're more than happy to go and guide you in that direction. You are eligible to put in a flat dollar amount as well. We don't advise that in the event that you're working an hourly wage. That amount is going to come out regardless if you're working, part-time, you're out sick. If you're going to save, say, $100 per paycheck, if you're only going to get a $500 paycheck, that $100 is still going to come out. And that could be, a quarter of your income. So please make sure if you are working an hourly schedule, we do really recommend putting in a percentage rather than a flat dollar amount. If you are an individual that are looking to save, say, a specific dollar amount for a year total, like $5,000 or $10,000, or the IRS limit of $19,000 for 2019 is what that IRS total contribution limit is. And then if you're over age 50, you can put in an additional $6,000 for a total of $25,000. That is the IRS limit. So if you are in kind of that camp of putting in $5,000, 10 grand, 19, 25, whatever it may be, is that you could take that larger number, divide it by the number of pay periods left in the year, and then you'll find out what that per pay period number would be, and that would get you to that exact goal by the end of the year. So a couple options there. I wanted to pause to see if, Scott, you had any questions on the contribution amount, pre-tax or Roth, or a flat dollar amount at all?
Nope, still all clear.
Okay, awesome. So we're going to hop down to the investment section, which is often kind of the hardest question to answer. On the top of the second page of this paper PDF form are listed all of the investment choices. All of these investment choices are all institutional grade mutual funds, which that means to the investor or to you is that they're the lowest cost option available to invest in. All of these investments are all top quartile performers as well. So they're the top investments in their category as well. Part of Mark and I's role as advisors on the 401k plan is to make sure this investment menu is dynamite today, but it's dynamite and good into the future. Part of our service to the plan is reviewing these investments every single quarter to make sure that they are meeting certain criteria. If a certain fund does not meet that criteria for consecutive quarters, we'll pull that fund out and automatically replace it with a new fund in that specific category, so a like-kind replacement. There's notices that get sent out automatically to all the participants, letting them know about that change. There's no heavy lifting that you, Scott, have to do. It automatically happens behind the scenes, and it's constantly getting improved over time. So this plan is great now, but it's always going to be great because we're constantly reviewing these investments every single quarter and being mindful of those choices for participants. But with that being said, you've got great choices and low-cost options. That doesn't help you with picking them. So part of our service and education to all of you as participants, Mark and I put together a model asset allocation guide. And what this is all the investment choices listed on that left-hand column. The asset class that fund represents is in that second column. The ticker symbol is a common reference. If you wanted to do a little bit more research, you can literally throw this into Google, pull up Morningstar, or pull up that fund family's website and find out more information on it in real time. And then this top larger rectangle is more of the hands-on model. We built 5 models or 5 portfolios that are diversified to that risk tolerance or to that allocation. So depending on what your risk tolerance may be, then you could follow that exact column and reference exactly what's in that fund or what's in this column back to that online enrollment worksheet or that paper form. So as an example, let's say you were a 50-50 investor, you were nearing retirement, this was the most appropriate for you. You would simply look at this fund, 2% DFA emerging market, go to this form, find the DFA emerging markets, put in 2% here, go to the next fund, find 2% for the Vanguard Total International Stock Market, Vanguard Total International Stock Market, put in 2%, and so on, and go down that list. For education purposes, the aggressive column, that 80-20 portfolio, is going to be more for those individuals who are going to be, in their 20s and 30s, and even into their 40s. Folks that are in their 40s and 50s tend to be in that moderate aggressive column, or that 60-40 or 65-35 mix. And then folks that are in their late 50s, early 60s, even into their 60s, will tend to be in that moderate column from an allocation standpoint. The ask of the individual or the employee is to, if you're going to follow one of these columns, is we come out with quarterly updates to this with new percentages. So the ask of you is just to follow that guide if you're going to, is to make sure you're in front of what we recommend you to be invested in. There are certain funds that are in favor and out of favor depending on the market cycles and economy and so on, world economy, and we want to have you have the best chance of having the best possible return by following that guide. So it's a little bit more hands-on approach. For those who want to be a little bit more hands-off, then the target date series is a great choice. Target date funds work in the way that you would find out what year it will be when you reach age 65, and that's going to plop you into one of these target date ranges in that second column. And then that fund is going to be the most appropriate one for you based off of your date of birth. And the way it works is very similar to the up columns above. From a risk standpoint, is the younger you are, the more aggressive the aggressive mentality is, because you're looking for growth rather than preservation. These blue ones that I've highlighted, the 4 on the bottom, are going to be very similar to that aggressive column, 80% in equities and stocks to 20% in fixed income or bonds. Even some of the higher ones and have a 90% stock exposure. And then as you get down in years, every 5 years it de-risks over time. And then the next 4 are going to be more in that 60-40, 70-30 mix, or that moderate aggressive column. And then the ones that are closer to the vintage year or the year of present date are going to be closer to that 50-50 portfolio or moderate, because this individual, if they're going to be in this 2020 fund, there's probably around 60s or in their mid 60s right now. So whatever is going to be appropriate for them is going to be around a 50-50 portfolio for those individuals. If you're younger, if you're 20s and 30s, the most realistic fund is going to be the bigger the year, and you can find out that. These funds actually retire over time, so this 2015 fund will actually go away in a few years, and then the 2065 fund will actually come out as well. So be mindful of what you're selecting. Target date funds are very popular as well for that set it and forget it mentality or autopilot mode. And the reason being is you don't have to worry about it. You go 100% into that one fund. It automatically de-risks over time for your risk tolerance with time frame left until retirement. About 70% of individuals that are participating in a retirement plan choose the target date funds. So they are a popular choice and are the default in many 401k plans as well. So I'm going to pause there. We've got one option as a hands-on, second option is a hands-off. The third is you can do whatever else you want as well. We just wanted to provide a roadmap of what would be appropriate and diversified for you to pick and choose from. You can change your investments every single day if you would like. There's no trading cost, and there's no cost of going in and out of any of these funds as well. So I wanted to ask, is there any questions that you guys have at this time on any of the questions or any of the things that we've covered so far?
Still all clear.
Okay, fantastic. So the last and final thing that we'll cover on this sheet is our contact information. It'll be included in the body of the email here, but feel free to reach out to Mark or myself with any one-on-one questions that you have. We're here to your discretion at any time. So I'm going to hop back to the PDF form. If you are completing this document as a waiver, if you don't want to participate, make sure you're printing your name and signing it and then giving it back to Scott. If there's any questions, feel free to ask him or ask us. We can help you through that. And the last 2 items that we'll cover over quickly is the beneficiary designation form. For those who are completing the online enrollment, you won't have to print out anything. You can do it all electronically over the web or even on your phone. And you can complete the beneficiary information electronically as well. You can also update that in the future. All the information that we've covered so far, your contribution rate, the traditional versus Roth, the investment choices, you can change at any time. You'll have 24/7 access to the website, and you can adjust it at any time. The beneficiary form works exactly like that, or the online version of it works exactly like that too. Beneficiaries are important because in the event that you pass away, the monies that you've accumulated in your account or rolled into your account will then be transferred to that individual in that name who you referenced. As an example, husband and wife couple with 2 children, the spouse would be listed as primary beneficiary at 100%, and then the 2 children would be listed as 50% contingent beneficiaries if you were going to share it equally. One also quick reference, this is an IRS rule. On the bottom of this form, there's what's called a spousal consent. In the event that you do not name your spouse as primary beneficiary at 100%, then your spouse has to sign and acknowledge that they're, call it being skipped or not first in line, and a witness notary also has to be present as well. So don't want to create any arguments at the dinner table. That's an IRS rule, but it's most cases that your spouse is primary beneficiary, and then you can list contingent ones. And then the last and final thing that we'll cover right now is the plan account rollover. In the event that you have an IRA or a 401k plan that's out there from another company, or it's just kind of being neglected in a way, and you want to consolidate that, you do have an opportunity, if you're eligible to participate in the plan, to enroll and roll over those balances into this company 401k plan. And also it works on the outbound. In say 5 years, 10 years, 20 years from now, if you're no longer working with the firm or the company, you can then roll out your money to that other company that you're working at now, or out into an IRA as well. And the 401k plans and those retirement savings, if you think about it this way, is they kind of follow you wherever you're working. I can't tell you the amount of times that we've talked to participants, and an employee will say, well, I worked for this company about 10 years ago, and I think I had a 401k with them, but I don't remember where that money's at. And we don't want that to be part of your story. So make sure you're keeping track of your logins as you're changing jobs, or moving different houses and apartments or whatever. Make sure you're keeping track of your logins, updating your address, because it is your money, so you've got to keep track of it. And please make sure you're doing that. If this does apply to you, or do you have any employees that do need assistance with this, Stephanie Wolf at Retirement Plan Consultants will actually be a dedicated representative that will help with that transition from that current company over to the Wing South 401k plan at Retirement Plan Consultants. So that is all the details there. Again, the heart of this document is going to be that online enrollment, second page. If there's any questions you guys have, you're free to reach out to us about the allocation guide, any investment selection, or anything else that we've covered today so far. We'll make this video link available here probably in about 30 minutes via that YouTube. And then if individuals can reach out to us one-on-one with any assistance and any help that they would like as well.